So this is, as the title would suggest, the self-storage panel, which was described as more than sheds, unpacking a decade of sophistication and future potential. So big words to live up to, but I think we're here with the right group to do it. So with that, I'll introduce the folks on the panel. So from end to end, we have Ollie Saunders, who's head of self-storage at Savills, Jasper Gilby, who is head of alternatives, living and strategic transactions at Nuveen. Next, Adrian Lee, who is an independent consultant, but for 20 plus years was the operating director for Big Yellow and a co-founder of that business. And last, but certainly not least, Iseldi Lutz, who is a director in the capital markets self-storage team at JLL. So please give them a round of applause. Make them feel welcome. And as far as everything else today, please jump in and ask questions. I think we all would find it more engaging and fun to be here if you guys want to be a part of the conversation. So with that, maybe I'll start with Adrian. So we've been, this obviously is a conference focused on real estate investment, but curious to ask your opinion on, is there an opportunity to build a European self-storage management platform and brand versus specifically focusing on the real estate?
I think that in America, we've seen quite a few large brand operators running self-storage centers on behalf of investors. And in the UK, we've started to see one or two operators who've emerged. So we've got Flexus, we've got Engage, we've got Storage King. But increasingly, those guys are also investing in as well as managing assets. And I think there's a clear conflict where that happens. But the opportunity must exist for people to come in and to manage these assets on behalf of investors. So whether it's Jones Lang or Savills or third party that can come in and actually be genuinely independent and just be a brand and manage self-storage assets for the investors has got to be an opportunity. And we're just going to have to follow what they've done in America. And there's no one doing it in Europe yet either. So the playing field is open for everyone.
And by the way, the other three of you, feel free to tag on to anything he's saying, because I'm sure you have views as the conversation evolves. So Jasper, maybe as some people in the room know, Nuveen has been active in the self-storage industry in Europe with notably two large transactions, one in the Nordics and one more recently in Italy. So it's clear that it's an attractive part of your portfolio today, but from a maybe a more specific perspective, do you view it as defensive? Do you view it as opportunistic? Why is it an important part of Nuveen's allocation?
Thank you very much. Yeah, thanks, Craig. Afternoon, everybody. I think from a portfolio fit perspective, and even if I look at Nuveen, we've been on a significant rebalancing of sectors. If we went back 7 years ago, 2/3 of our assets under management on the equity side were in traditional sectors, offices, retail. I'm not here to office bash, but what I have seen is a massive shift, and that has all now moved into industrial living and alternatives, and self-storage being one of the larger alternatives from our side. So we've seen this huge shift, and we're seeing that play into all of the different mandates at Nuveen, from core to core plus to value add. And in answer to your question, I think the defensive side of it really is playing into the core mandates. We're very focused on income. I think they really like self-storage. They like the nature of buying high quality, stabilized assets where you can move rents along in an unregulated manner, diversity of income, minimal NOI leakage. So that really plays into our core mandates that are looking to generally distribute and deliver an attractive distribution yield. And typically we're looking at, say, 4.5% day one income yield, 10 to 12% IRR, something around that over a 5-10 year basis. And then the value add side, I think, is equally interesting, and where we see the opportunistic plays of looking at perhaps early stage development-led aggregation plays of buying developments at sort of 9% plus development yields. And that's, I guess, where we're seeing a 300 to 400 bip spread to stabilize, which is sort of driving the kind of returns that are getting our value add money out of bed.
Great. And maybe to the capital markets folks in the room, Ollie, for anyone here who, during the conversation, is convinced about the merits of self-storage, how do you evaluate different entry points into the sector? There was some conversation in the other room this morning about building versus buying. How do you advise clients on the right way to find access to self-storage in the UK or in Europe, other than buying listed shares, which probably isn't so interesting for any of the five of us?
Yeah, I mean, there are multiple entry points into self-storage in a European context. One of the frustrations is that the scale hasn't necessarily been there for a number of years, and we're now beginning to see platforms that have been built that have got 100 or 200 million euros of value. So the investor field becomes interesting at that side. We are seeing a lot of investors who are looking to enter because they've got their own real estate and they're doing their own developments. So actually, we're seeing a lot of repurposing of assets coming through on that basis as well. And there are some platforms that are going to be getting ready for sale, and we're beginning to see the sort of the billion-dollar portfolios actually emerge. So what we're seeing in the European market is really what has followed the US market. We're probably 20 years behind it. And one thing that I think we're probably going to debate on this panel is the difference in terms of quality. And there are a number of, so 50% of the stores in the UK roughly are what we call second generation. So they're pretty average quality conversions, and we're beginning to see more and more new build high quality assets coming into the market for the economics that we'll talk about. And I think it's going to be very interesting to see where that sector, where that part of the market goes. And we've got obsolescence beginning to come in and how people are going to value that as well. But we absolutely know that high quality assets in great locations with good management teams perform really well. And it's that sort of predictable cash flow. But quality is a point in the market, isn't it? Which I think Iseldi may have views on.
Yeah, and maybe just to add, I think what everyone has sort of touched on is, I think the big issue in the market as well is the fragmented nature of the industry. In most markets, almost 60 to 80% of the market is made up of mom and pops or, owners who only have one or two properties. And so that's a real hindrance to entry in the market. And I suppose also what drives the different pots of capital. You do need a good management team who can deliver growth at scale to deliver those value-add strategies, and there's only so many core capital opportunities available. But once it's there, it's beautiful. It's just this very vanilla, high-quality asset.
There are at least 4 other people in the room who believe it's beautiful. Don't worry. Hopefully more by the end. Maybe following up on the capital markets point, Iseldi, I'll stay with you. There have been a number of large portfolios or platforms that have been up for sale in the prior 12 months. I think probably to the disappointment of some of the people in the room have not traded. Curious if you think this is evidence of, I'm not going to say a problem with the sector, or what do you think it is that will ultimately unlock more capital markets activity that allows the sector to move from 20 years behind the US to something closer?
So I think, from a market sentiment perspective, it's certainly, from the outside looking in, it's not great that 2 billion sterling or euro portfolios did not transact. JLL was fortunate in that we were on the buy side on both of those transactions, and without pointing too many fingers or saying too much, I think there were some very unique reasons as to why those didn't trade. I think actually maybe some of the positives behind the whole process is that on both occasions, it attracted big names, large institutions who spent a lot of time getting their heads around the sector and are very excited about the sector. They understand what drives performance. They spent a lot of time, and I'm sure Ollie as well spent a lot of time, unpacking what drives demand. So it's a really positive in the sense that we've got more core buyers joining in the party. We really need that type of sort of return threshold investors. And a lot of private equity have been growing and scaling portfolios, which will come to market in the next 3 to 5 years. They've obviously all chased the value add strategy and the sort of lease up profile that brings those high returns that Jasper has been talking about. So I think in combination, we'll have a lot more opportunities, a lot more portfolios at scale. And that's really what we need to demonstrate that you can take a portfolio from 50 million to 100 million to 1 billion and have different pots of capital interested in each of those journeys. So I don't think, in summary, there's anything wrong to be concerned about, but...
And just very quickly, I think on some of these large portfolios, self-storage is really granular, so you need to go into the micro market of what's going on in Guildford versus Basingstoke, and to explain to investors who are new to the sector what drives rent, and that does take time, and making sure that you're properly prepared. but also there were some mid-market portfolios where people came out and they just thought they chanced getting a high price because everybody loves self-storage. And when you get into the underwrite, you could see that some of those pricing expectations are very high from sellers. And buyers have all got the same cost of capital or there or thereabouts, and it is a mathematical equation. So there was some sort of emphasis that was put into the market that maybe we'd hit new benchmark pricing, and that just didn't happen. So I think there's a reset in the market, and people are realistic about the opportunity cost of not selling their portfolios, and people are looking to exit because they want to get on and do things as well. And I also think a great point for liquidity is I'm 52 years old and I'm really young in self-storage because a lot of people are quite old and they want to sell. So there's going to be this huge dearth of exits from people who are 65 to 70 who want to go and buy boats. And I think that their expectation is lowering, isn't it? And I'm sure you're quite optimistic about some of these people.
I love
who
that
are
pointed
slightly
comment there,
older.
Ollie, that's great. But I'll represent the over 60s, it's fine. But I thought, just going back to the sort of the start of the discussion point, I thought it was incredibly encouraging for the market that although these transactions did not perform, there was strong bidding potential in there. So that was the really credible bit about it. And all we'll need is, there's a bit of a mismatch at the moment between the expectations of vendors and the pricing of purchasers. And that's probably a cautionary tale following the interest rate environment we've been through, the Trump tariff environment, et cetera, et cetera. So 2024 into 25 was quite a tough environment from an investor's point of view in terms of wanting to take a particularly speculative decision. So, but the encouraging point was there was money there. There were multiple bids there on both portfolios. So there's interest.
Certainly. Maybe to Jasper, in thinking about platforms as different investment opportunities, given you as Nuveen have been active in this space, what things are you looking for to make a platform investable? Is it the team? Is it alignment? Is it some level of tech stack that you think is valuable? Is it a market share? All the above. Curious how you think through what is a platform and how do you approach it?
Yeah, well, I think almost taking a step back just on the last question, I mean, one of the other things that we have to deal with at Nuveen, I guess, is a lot of our capital is global. It's best relative value. It can go into APAC, US, Europe. It can go into sheds, private credit, storage. So that's always one of the constant elements we're battling with is, where is the best relative value for that capital? And certainly in recent uncertain times, all of that has flowed into private credit. And I think where we start to see a little bit more comfort or, I think markets have started to recover, stability, flipping back onto the equity side, which again, hopefully will return in the next couple of months. I think when we look at platforms, and I look at Green Storage, we have 200 facilities, vertically integrated platform up in the Nordics, so pan-Nordic platform. A lot of it, I guess, is the location fundamentals that Ollie mentioned. A lot of it comes back to buying into hubs, the Stockholms, Copenhagen, Oslos, growing cities, growing demand, expensive living, mobile housing markets where there is just simply the demand for self-storage. We went there early on in our journey because, frankly, it was a mature market, less competitive than the UK, accretive financing, opportunity to create a platform in what we felt was a relatively low-risk entry point. You already had Shurgards and Pelicans already operating, so rents were proven to a certain extent. But then, management team is absolutely critical. The operational team, all about the revenue management, coming into Adrian's world. But I mean, that is critical, that constant balance of rate versus occupancy, dynamic pricing, how we shift rates on is absolutely critical. So having that sort of operating platform combined, I think, with the development, which we have as well in the Nordics, the in-house development team to try and capture that 300-400 bip spread. We would much rather capture that in our platform than go and pay a premium for a new platform, because that's really where we see the value. But it's super granular, as Ollie mentioned. And then the key one, final one for us was the unmanned play. We really like the platform predicated on an unmanned automated strategy. The Nordics is probably one of the more tech-savvy regions, so I think it was probably more of an embracer. But even since 2001, we've seen that the full-time employees per site has gone from 1.7, 1.8 to 0.47 as we've grown the platform. So we've kept our cost base stable, but we've seen significant growth in that journey of web to app-based access to the site, to Nokia electronic systems to get in. We believe that efficiency is going to be key in what is a pretty commoditized product.
You look like you might have a thought, Adrian.
Sorry.
I'm coming to you with the next question if you don't have a thought on that, but you had the mic ready.
I'm going to answer in the next question.
Okay. Fine. So talking about operational efficiencies within businesses, obviously unmanned models are one thing that comes up often in self-storage, and what tech is enabling as the sector moves forward. But from your time at Big Yellow, if you were looking at other forms of operational efficiencies, what worked, what didn't, curious for some, some secrets from the road.
Okay, operational efficiencies, and in particular cost control of operations, is absolutely critical in self-storage. So whatever management platform you've got, or manager, then this is the sort of number one conversation, because the focus is always on occupancy and rate and the revenue and driving the top line, which is part of operational management. But the bit that no one ever talks about is cost control. And in self-storage, there are sort of the three biggest costs. This is referring to Big Yellow. So in the traditional self-storage sector, the three biggest costs would be any debt costs you've got, any business rates cost you got, and the cost of staff. And those will be 85% of your operational costs. Now, obviously, interest rates have been through a peak and fallen back down again, but just decisions on capital structures are put to one side. The operational team can't really do very much about that. However, the other two are very, very important areas that need to be carefully thought about. And staffing is obviously the number one of those. And it's great to hear what has been going on in green storage in terms of reducing headcount, which curiously, Big Yellow has also been doing. But Big Yellow is very much believes in the manned model, because there are benefits to a manned model as well. No one ever talks about the benefits of a manned model. Everyone talks about the benefits of the unmanned model.
That's why you're here.
Which is great. And I sit squarely between the two, because I do believe there's room for both to be there. But the benefits of the manned model is your ancillary sales, your service side, and security. And UK has has a security level which is probably different from other levels of Europe, but issues may happen elsewhere. But those are reasons to be having a manned model, and you can get payback on that from your headcount. But even Big Yellow has reduced headcount from about 3.2 down to, I think, just about 3 it is at the moment per store, and that trend I'm sure will continue. The unmanned model, is fantastic as well, but you have to start with a different prognosis. And I think unmanned works for smaller stores, regional store portfolios, super urban store portfolios. But the key point about unmanned, I think, is small, because you are missing at the margin the business services. So if you want collection and delivery, if you want help forklifting, et cetera, all of that's gone on the unmanned model. So that's a chunk of your business community who can't use you. So there's a cost to that. So that's the on the staffing side. Business rates is the other sort of issue that needs to be addressed. I mean, as values have fallen in offices, as values have fallen in retail, so B8 and warehousing and self-storage, by association with that, is picking up the burden on the business rates. So Big Yellow's increase in business rates over the last 3 or 4 years has been phenomenal. And it's how you mitigate that. And what is interesting, again, in innovation is a lot of the newer drive-up models, which are starting to be introduced in self-storage, are pushing that cost effectively back to the customer. So the B2B model works in pushing rates over as a cost to the customer and not a cost to the operator, which is obviously makes a massive difference in your operational cost. So there are all sorts of things that have been happening within operational performance that are allowing you to adjust and introduce different models within self-storage. And I'm sure we'll come on to talk about that. But, not just the traditional method, but other operations in self-storage. So, yeah.
I wanted to transfer over to Ollie, because this is a topic we've covered a bit before in terms of the new building formats, or let's call it, different generations or evolutions of types of assets themselves. I mean, what are you seeing in the the micro space, urban formats, both from an operational standpoint, but also from a kind of valuation or capital market standpoint?
Yeah, I mean, COVID was great for storage because it did a couple of things. Firstly, it showed that demand really peaked and that it was a great asset class. But also it really proved that the technology worked and you could actually take staff out of stores. Now, Big Yellow spend £15 million a year on their salary bill for 100 sites. And as a result of this, understanding that you can actually set up a self-storage facility in a room of this size and actually automate it. And in central London, we're seeing rents for some small self-storage facilities nearly hit £100 per square foot. And you don't have to employ a member of staff. And the tech is available off the shelf, and the IT systems are here, and there are suppliers here that can set it all out for you. So that's going to bring, in our view, quite a lot of new innovation for the first time in 20 years in the self-storage industry for new products. We love the drive-up concept. That really appeals to the B2B sector of the self-storage industry, where self-storage really loves the domestic customer. It's quite likes the business customer as well. So we're seeing a lot of that innovation, and stores which may be 20,000 square foot or 2,000 square meters in city centres that can have a hub and spoke system as well. So it's bringing a lot of innovation and efficiencies to drive, and that will bring in new supply. A question for perhaps Adrian is, for the big stores, are we going to see lots of small self-storage buildings infill in between some of the big stores and city centres and bring that new level of competition?
I mean, I think that's a natural migration, both regional with a drive-up model and urban with a sort of small micro-location model in urban. But traditional self-storage has never been able to get into the city centre because they could never afford the real estate. So that gives the opportunity for the urban model. And traditional self-storage, if you're building a 5,000, 6,000 square metre store, if you're buying a plot of land and building it, you're in for 8, 10, 12 million pounds. You're not going to get an economic return from a small town from that. But a smaller drive-up unit, cheaper land, cheaper construction cost, quicker planning process, quicker construction process, you're into revenue generation much faster, gives you the chance to go into smaller locations. So there's a position for all three different models in the market.
Maybe on just a valuation standpoint, talking about some of these new versions of, it's funny, you knew where to go with the mic. But from a JLL House perspective or a valuer's perspective, are you incorporating things to do with these new operating models into your guys' valuation process, or is it sticking to line items and financial performance, or are you actually evaluating, okay, this is a digitally led store, therefore there's some sort of evaluation adjustment or premium for that, or perhaps the other side of it is this store could not operate without the following technology or without the following personnel load, therefore a average operator or owner in the market might not be able to run the store as efficiently as the person who's selling it or valuing it. Just curious how you consider those things.
Yeah, I mean, of course, I think you have to understand the I always say, valuations is like a hymn sheet, and the income needs to sing along with the expenses. So you can't be really upbeat on your rental rates and not spend a penny on marketing. So it is about understanding the strategy of the operator. But I think more importantly for valuers in general, it's understanding the market and what is driving that income. So there's also a lot of focus on the demographics. We know that the affluence drives the rental rates, but actually the population density drives the occupancy. So it's about understanding who's the clients, why would they pay, why do they need to store, and then it's about understanding the business model. Now, obviously, there is in valuation speak something like a reasonably efficient operator, but if you hold everyone up to big yellow standard, perhaps they'll fall short. But so it's a theoretical thing, but I suppose understanding the income and the expenses as a whole package is key in what drives the value.
And one of the key points is the cost of replication. So sometimes the income is enormous relative to the cost, and how easy it is to actually build micro stores in city centres like Barcelona. There's a huge valuability of real estate, so that is one of the key things. But also, I love self-storage loads because it's actually an inflation-linked income stream, and if you've got scale with urban self-storage, and the customers tend not to move out in some of these micro locations. In Big Yellow, 8% of your customers move out every month. So there are some different sticky characteristics for these new formats, and I think we're just discovering how that performance is going to be. But there's lots to think about.
I have one last question, and I want some from the room. Hopefully, let's see. For Jasper, if you could have 300 million euros in a dominant platform in self-storage in one European country, or that same amount of investment spread across 4 European countries, how would you think about that?
Yeah, I mean, I probably spend more time on the phone with our management team in the Nordics than my wife at the moment. So I have the idea of having 4 of them, as much as great as that is probably not that appealing. But I think the operational efficiencies I think we get from a single concentrated platform is huge. So I think one of the big considerations for us is the idea of going across multiple jurisdictions, each one having to have its own operating platform, navigating different currencies, different corporate structures, taxes, makes it really challenging. And frankly, not just for storage. We see the same thing across our student housing platform, across our office platform, across sectors. So I think almost as a general point, we would be navigating more towards depth in single markets. And I think storage only amplifies that, just given the very operationally intensive nature of the sector. The best deals we get are in strategies where we have a really deep local sourcing team. And these are granular sites, so these are not sites that we're picking up from a widely marketed JLL. They're often pretty scrappy through private investors, through change of use, a lot of structuring, conditional deals. Really, really big lifts, but you can't do those, I don't think, unless if you are scattered thinly across multiple markets. So I'd go concentrated. Having spent a lot of time in the Nordics, it was great to be back in Italy because a bit of sunshine and slightly different type of food. Love the Italian market as a really interesting nascent play. So that would certainly, from more of a value add perspective, we like the Italian market. From a core plus perspective, we like the Nordics.
Well, perfect. Conscious we have just a couple of minutes here, so if there's anyone in the room that has questions for the panel about the sector, about the investment landscape, things that they would be curious to discuss further.
No, it's very similar to the hotel management model. So there's a brand and then an operator, and they don't own any of the assets. They're all independently owned. And it is developing in the UK. It's happening. It's starting. There are 3 or 4 operators who are doing it. I'm not aware of anyone in Europe doing it yet. I think it's all owner operated in Europe. But there's the opportunity to manage different platforms. I mean, the operational skill set is pretty common across the whole of Europe. The real estate is obviously different and the capital structures are different, but the operational real estate is very, very similar. So the marketing strategies, how you run your store, manned or unmanned, how you cost control, how you drive the best revenue management out of it is all common across those countries. So there's no reason why you shouldn't be able to operate platforms across the European structure. So it's just, so far it's been embedded with the capital very tightly and hasn't, as more investors are trying to get into the market, so more of them are looking for people to start managing assets on their behalf. And that's an opportunity. I was going to say, one of the things I really wanted to point out, which has been a sort of our investment mantra at Big Yellow over the last 20, 25 years whilst I was there, was that one of the major benefits of self-storage investment is the ability to grow, compound growth of earnings over a substantial period of time. And 2 facts in this year's results that came out from Big Yellow really stuck with me. The first one was that the total return over the Big Yellow has been quoted now for 20 years. And in that 20-year time period, its total return to investors is just over 12.5% compound for 20 years. That's pretty impressive. I mean, the total stock market return is about 5.5% compound return in that time period. So that's showing the ability of self-storage to outperform normal market segments over a long period of time. And the other factor that's been very impressive is in the last 3 years, which have had incredibly high interest rates, incredibly high energy costs, massive increase in staffing costs, national insurance, minimum wage, et cetera, Big Yellow has grown revenue 19% and earnings per share 10% over that 3-year period in one of the very tough financial economic periods. So that again shows the resilience of self-storage in quite a sophisticated market. So those sort of 2 factors really stood out for me as to why
Adrian, everyone's just going to buy shares in Big Yellow and not do private transactions with any of us. But
So obsolescence really ties back into quality of the portfolio that you invest in. So I won't talk about Big Yellow because it's obvious with a purpose-built store that obsolescence is that much less than it would be in a traditional portfolio. But Big Yellow invested in something called Armadillo Storage, which is a platform, the original platform they've acquired in chunks of 5 or 10 stores from different operators. And Big Yellow then invested in the money that was never put into those stores when they were first set up. And the obsolescence in those, and none of these are purpose-built stores, these are all refurb stores. We've spent a fortune on roofs, fortune on lifts. And once you have put that investment in, they perform in a very similar way to the Big Yellow portfolio. So the sort of number one lesson in investment in self-storage is never underinvest in operational assets. Roofs, lifts, gates, they need to work. You have to invest in them. So, we endlessly acquired assets where they'd been a cheap roof, a poor quality lift, and the neighbor's gate. And it just doesn't work. You just have to rip it out and start again. And once you've done that, then you will find obsolescence is really something that's very controllable. There is obsolescence, but it's nowhere near as much obsolescence in self-storage as there is in hotels, residential, student accommodation. What else can we slag off?
where's the program? Yeah. Perfect. I'm conscious of time, just 'cause we were told to stay very specifically at a half an hour, but if there's any last comments from the room, questions from the room? Okay, great. Well, I'd appreciate another warm round of applause for the 4 panelists.